is today's market rally just a one-day occurrence, or is it sustainable? Joined by Stephen Wood, the chief market strategist at Russell Investments, where he helps manage $179 billion in assets. Steve, great to see you back on the show today. So what do you think? Our earlier guest was saying that there's some real strong fundamentals, profit growth, as a driving factor to the stock market, yet you have these lingering concerns about what's going on in Europe. In fact, we just had a headline cross last hour that now Moody's is stepping in, threatening to downgrade Greece to junk in the next 4 weeks, following, of course, S&P. How do you make sense of it all?
Well, you know, way to get ahead of the rating forecast. But I think that what we're seeing is the Greece issue is representative. Greece in and of itself may not be terribly important systemically to the economy, to the capital markets, but what Greece represents could well be. So is Greece, you know, a peek into the future for Spain or for the United States a couple years down the line? So this is what happens. We've transferred, in this deleveraging since 2008, we transferred all this private debt onto the public balance sheet. And not every public balance sheet can withstand that. So we're beginning to see how the final stages of this deleveraging globally takes place. With regard to the EU bailout, some suggest Greece is simply inflating its debt, biding time and not dealing with the real solvency problem. And that's what we're looking at right now is a Euro TARP situation. So the European... Le TARP, as I've heard it referred to as a few times. Which is far better than my Euro TARP. Le TARP. So if we're looking at the ability to create the shock and awe environment, to create liquidity, and then ultimately I think to create solvency is going to be the issue, because what we can't let happen is for this to spread into Spain, into Club Med, and the important part, I think, is that a lot of this Greek, Spanish, Portuguese debt is held by French and German and Dutch and Belgian and Swiss banks. So they're also radically self-interested as well. Okay, so is it going to keep the credit lines flowing between these European banks? I think so. What we saw in the United States is we acted alone, and now we're acting in concert with the Europeans. The Fed opened up the swap lines over the weekend as well, so there's a lot of dollars flowing. The European Central Bank is taking a much more soft approach than they did just last Thursday when Trichet gave his interview. So I think that what we were able to accomplish here, I think will by and large be accomplished in Europe. It won't be without consequences, but I think it's really a necessary nostrum for what's ailing markets. It's moved from the U.S. into Europe, and they're kind of fessing up right now. Meantime, the U.S. economy is cruising right along. We had that strong jobs report Friday. I always get tongue-tied on Mondays. I don't know what it is. How likely, or what is the threat that this European contagion could curb our recovery and our jobs recovery, which is of what most people are concerned about right now? I think right now it's a lower probability event than it was a couple of weeks ago and certainly a couple of months ago. I don't think that from Russell's perspective it's really changed a lot. You know, the fundamentals that we were looking at are by and large intact. I've been talking to clients for well over a year and a half about stress fractures within the euro, that Europe would need to address these issues, and we've seen that come to roost. But the U.S. economy is doing okay, perhaps a little bit better than okay. Are you leaning back toward a V-shaped recovery? I never was at a V. I'm a square root sign recovery guy. You know, coming kind of perpendicular. It was a bad recession, and I think we've had a condensed recovery, but it's not going to be terribly brisk or terribly high. So the U.S. economy does okay. Corporate earnings are doing great, and I think revenue is beginning to stabilize, and you're beginning to see some pricing power. So I think the markets, the fundamentals, are doing better than okay in the United States. I think probably the biggest fundamental story in 2010 is what China's doing. I was just going to ask you about Asia, because there were a lot of writing this weekend suggesting that there was going to be a threat of contagion into Asia. We had what China manufacturing was at last week's report that was really, really light. So you've got industrial companies, right? Caterpillar, for one. I mean, they're basing their whole outlook. In fact, Caterpillar boosted, right, because of the Chinese forecast. And so that's why you just want to be a little tepid and diversified in that what used to be a great currency kicker, that if companies earned profits in euro, and they could repatriate these at really higher rates. That's kind of moved the other way now, so domestic earnings are pricing higher than would be international. But also the idea that China would be this massive engine of global growth, that China would lead us through this, is going to be lower. The Chinese are actively exiting. So whereas the Europeans are just beginning to discuss the terms of their emergency liquidity fundings, and we're kind of in the 7th or 8th inning of our liquidity measures. The Chinese are actively pulling liquidity out. So the economy is going to grow slower there, and I think that's really where you saw the volatility come in January, was when the Chinese said, we're not talking about it, we're doing it. Around the world in 80 seconds with Stephen Wood, Chief Market Strategist for Russell Investments. Thanks so much for your time and insights. Appreciate it.